morning, ARMR Insiders. Welcome to the morning meeting of our virtual hedge fund. Thank you all for joining me. This is our live look-in on a Wednesday. We do this every morning meeting, 9 to 9:30. Sometimes it spills over after the bell. Get ourselves ready for our trading session. We're investing in the stock market. We're talking about managing risk first and then capturing upside. This is a virtual hedge fund. I ran hedge funds for a decade, been running capital for 35 years, managed my own private capital, family offices, and then some capital for others. Okay, so we've got I would say assets under influence of 150 million, somewhere around there. We have subscribers all over the world who are bringing quality information onto our virtual hedge fund desk, and we share that information all day. So if you have an interest in joining us, feel free. Take a look at armorinvesting.com, ARMRinvesting.com. Don't forget our Substack. It's free, armorinvesting.substack.com. It's where we post all of our research, so you know stocks to watch and why we're watching them, stocks to buy and why we're buying them. We share that information through our research arm over at Substack. So that's armorinvesting.substack.com. Any questions you might have, throw them up in the comment section. Every Wednesday we do the live look-in, and I share it with all of you on YouTube. I appreciate you all for following me there. And if you have any questions, you can always comment on this video, and throughout the day I'll take a look and see if I can answer it for you. All right, so diving in, we break down our virtual hedge fund into three distinct portfolios: ARMR Macro, ARMR Invest, ARMR Dividend. And then we wrap it all up in a bow, and we call that the ARMR Flagship Fund. So I share with you how I use those three portfolios to build the fund we use on this desk to manage capital for our investors. So ARMR Macro, ARMR Invest, ARMR Dividend, that's what I do for my own personal portfolios and the family office I run. And then ARMR Flagship is how we bring it all together and manage capital for investors. Okay, so this is not investment advice. This is how I run my own personal capital, right? It's how I run capital for others. So I respectfully request you think of yourself as a portfolio manager on a hedge fund desk. And so I'm going to share with you the information today, and then you have to figure out your risk tolerance, what your goal is, and then execute your strategy. Stop following smart money and be the smart money. That's our motto here. All right. So before I get into the precious metals page, as you can see here, these four are the top names I'm watching right now. First thing we're going to do is we're going to start talking about our macro fund. We have risk monitor yellow right now. We're waiting for confirmation. Color won't change until we get a weekly close below key levels or above key levels using ARMR algos. So right now it's yellow. There's a mixed market. We're having serious issues in the leaders, issues in the data center AI names, Nasdaq 100 names, the hateful eight names, and at the moment we're getting rotation out of those names into Coke, Pepsi, Budweiser, AT&T, Verizon, the tobacco stocks, the dividend payers, even something as lowly as ConAgra, Procter & Gamble. So what does this really mean? I'm going to give you an opinion of what I think is happening, and we're waiting for confirmation before we make any major changes to see if what I'm thinking actually is happening. So we always react to price action. We don't predict on this desk. We look at different scenarios. We discount them based on a probability algorithm. And then we need to see confirmation, particularly on a weekly level when we're talking about macro things, before we really adjust a portfolio. Okay. So what you're going to hear from me right now is that I am leaning risk monitor red. I think the market's going to switch to risk monitor red, which means I would lean defensive for the flagship fund and short for my personal capital. The reasons I'm leaning that way. There's a whole bunch of anecdotal information from 35 years of doing this. I've seen this before, and it's making the hair on the back of my neck stand up. This is not a prediction. This is what I'm seeing. I need price action confirmation before I act on it. Okay. So what am I seeing? In no particular order. I've already mentioned it. Number one, when money flows into Coke and Pepsi and Procter and Gamble and Budweiser and the tobacco stocks and Chevron and Exxon, that's usually bearish. Those are the type of stocks. AT&T and Verizon. God, go look at what those stocks are doing this week. Those are the type of stocks that go up like that because money's hiding. Okay? It's hiding. It's rotating out of technology stocks. These are the tobacco names. 3 of which we already own. We own all 3 of those. It's rotating out of innovative growth, big cap tech, AI, data center type names into the names to defend. That's defensive. That's usually bearish. We're seeing wild volatility enter the market. Wild volatility is usually bearish, not bullish. Even sectors that we love and that we've had massive success with over the last 6 to 9 months, precious metals, uranium. When silver drops 30% in 3 hours, something's not normal about the market. Now we can go talk about all the conspiracies on why that's happening and where silver's going next, but I'm not talking about that right now. I'm just simply saying to you, parabolic moves on the upside and wicked reversals and trapdoors are a sign of an unstable market, and that's bearish. A market that's bullish grinds higher. It just keeps grinding under the bears. The shorts just get ground to dust. Wild swings, that's part and parcel of a bear market. Okay? The earnings announcements out of the data center AI companies are getting a little bit difficult to read, and you're getting some wild swings because of it. I'll give you an example. On the one side, it's kind of strange. The AMD earnings announcement, it didn't look too bad, but maybe the market didn't like the forward guidance. AMD's down 10%. Then you got SMCI, which has been a laggard for a while. Stock's up 9% on earnings. But if you look at receivables that are blowing out, inventories that are skyrocketing, okay, you'll say to me that's because revenue is exploding because they're building out data centers. I get it. But that's kind of dangerous stuff. As long as they can deliver and keep building, that's great. But when a company's inventories skyrocket, if there's any slowdown to that revenue, they get stuck with inventory, right? So it's very important for us to watch DSOs, days sales outstanding. That's going to be the key. That's the canary in the coal mine of earnings like this. If DSOs blow out, days sales outstanding, meaning they're not getting paid and it's starting to balloon and they're stuffing the channel, then we have a problem. We're not there yet. SMCI stock's up 9%. DSOs were up a little bit in the quarter, but not anything out of a normal range. But I bring this up because the picture is getting very cloudy and the stocks are having wild swings. Now let's continue this discussion about things that are making the hair on the back of my neck stand up and concerns. We're having a bit of a credit crisis in private credit. Okay, I've talked to you about this before. This is the poster child for that. There's a massive head and shoulders top on Blue Owl Capital, and it's imploding this week. Software stocks are crashing, continuing to crash. There's the AI disruption. You could say to me it's an overreaction. Adobe's not going to go to zero. AI is not going to completely ruin Adobe's business, but Adobe stock keeps imploding, okay? We could debate that if you want. But the problem is 20+% of private capital, up from like 16% maybe 5 to 10 years ago. About 20% of private capitals in the AI is in the software space, software stocks, software companies, private credit, okay? So it's been ballooning as they're all spending, trying to catch up with AI or incorporate AI, none of which they get an ROI on. They're just trying to keep up and not become irrelevant. So they're borrowing private credit, spending an insane amount of money, trying to retool and keep up with what AI is doing to them. This is disruptive, right? And they don't have any ROI on it. And none of what I'm saying matters. I'm going to wrap up this discussion on macro right now. I'm going to wrap it up in a bow. None of this stuff matters if liquidity is increasing and there's smooth sailing when it comes to things like interest rate cuts or what have you. But the reason why it's mattering right now is the Fed has become a huge question mark in 2026. The probabilities of no rate cuts 2026 is going like this. So probably no rate cuts the rest of this year. We have a Fed chairman in limbo, can't be removed because there's an investigation into him. So nobody's going to remove him until the investigation's over, or at least that's what they tell us. And the new Fed chair that's been proposed is talking about reducing the Fed's balance sheet, which is quantitative tightening. So even if he comes in and cuts rates as the current administration wants, if he's cutting rates with one hand, but in the balance sheet with the other, that's bearish. Reducing the balance sheet is quantitative tightening. That's a liquidity reduction. Now we could talk all day about how important it is for the Fed to reduce its balance sheet. Austerity or whatever. I'm not arguing about that right now. I'm just talking about markets go up when liquidity is being added to the system. Markets go down when liquidity is extracted from the system, and markets start to wobble when the market gets worried that liquidity is going to be extracted from the system. So now we go back to Blue Owl. And so we have this private credit bubble that nobody cares about if liquidity keeps getting pumped in, but becomes a serious problem if liquidity stops being pumped in. And at this rate, we don't even need liquidity to be reduced. If liquidity just flatlines, we have a problem. Liquidity has to keep increasing to keep up with all of the debt. Okay? So it gets us to the chart of the day. This is the problem. It's the Nasdaq 100. It's the hateful eight names. And you're getting this alligator jaw in here. And the projection is you crash down to this level. Now, it hasn't happened yet. We're up here in this kind of pennant formation. So this is not a prediction. I'm not telling you this is going to happen. There'd be a lot of things that have to fall into place like dominoes for us to get to a collapse like that in the Nasdaq 100. I lived through that bubble popping in the year 2000. And so this is why I'm sharing this with you, and I'm concerned and I'm watching this closely, because we saw this same type of setup in 2000. I'm not going to compare the AI bubble to the dot-com bubble. Let's don't go over that. I'm just talking about liquidity reduction with the market priced to perfection. And the Nasdaq 100 collapsed 50% in like a 2-3 month window in 2000. Okay. So I've seen it happen before. When the dominoes start falling, it gets ugly quick. And so we have to be prepared for that. We don't predict it. But if we see something like this start to break down, we recognize the trap door that's underneath us. And we have to manage our risk. So what are some of the things that would tell us the trap door is opening? All right, a weekly close on the Nasdaq 100, a weekly close. So you can see we have a very clear negative pennant formation over here. Broke down, tried to recover, breaking down again. A weekly close down here, certainly taking out the low of last week, 607, let's say. Nasdaq 100 closes on a weekly level below 607. And now you have a confirmation of a topping wedge that's breaking down. That'd be very dangerous for the market. The other thing I'm watching, canary in the proverbial coal mine. Maybe not a canary. I don't know what you'd call this. Not a canary. This is the final straw. Okay, we're having an absolute parabolic move going on in SanDisk. We had a parabolic move going on in silver, and that's what happened to it. Okay, so don't tell me SanDisk can't do this. There's parabolic moves usually end violently for reasons that we don't know right now. Okay, that's a parabolic move. Now I love SanDisk. I made a lot of money on it last year. I'm not on this rip. I wish I was, right? So this is I'm using this as a guide. If SanDisk gives up the ghost, this is the centerfold of the AI data center boom. If that chart breaks down, it's all over but the shouting. So I'm watching that closely. You get a close on the triple Qs below 607. You get a major reversal on a weekly level. So it's up huge right now, but let's say, I don't know, I'm talking about something major. I mean, it closes down here at 534. So that the weekly candle is like a huge doji stone. I'm just giving you touchstones. If you see that, it's not a prediction. If it happens, don't be a deer in the headlights staring at it. Recognize that something dangerous is unfolding. Act accordingly. We call it the ARMR report. It stands for Algorithmic Risk Management Research. We lead by managing risk. Then we capture upside. We capture a lot of upside. We've had a monster move in the last 9 months. But it all comes from recognizing risk first. We want to be aggressive putting capital to work, which we did last year, after the market craters in April. We want to buy the weakness. At this stage, every day I come in and I say to myself, am I on the right side of probabilities? And is the reward worth risk? Okay. That I answered that question before I make the next investment. And at this stage, reward versus risk, you could argue risk is greater than the potential reward from here. Just look at that chart. Okay. And the probabilities that we blow out from here are diminishing like with every hour. So protecting capital is where we are on this desk. We got 65% cash right now. And we own the investments that money's rotating to. We own pharmaceuticals. We own large cap energy stocks, right? We're long Exxon from that green box in here. We're long Chevron from the same level right in here, this green box right in here. Okay, we're long Chevron from in there. Okay, we're long the pipelines from the green box. We've been long the pipelines for a long time, but recently we just added ONEOK. Okay, right in the green box here, and we got the dividend payout. They just paid a dividend on the 2nd. Okay, we're long KMI. Well, what a chart pattern on KMI. It doesn't get better than that. Look at that weekly breakout in KMI. I already showed you, British Tobacco. We're long British Tobacco. The thing's blowing out in a weekly cup and handle. So we've already shifted our capital, and we're watching the market come to us. We're going to keep leaning into that. I'll tell you 2 stocks at the top of my list to buy this week. And I'm not buying anything right now, but by the end of the week, I'm probably going to own Devon. Okay, Devon Energy. Definitely going to own, let me put that on the daily chart here. Devon Energy. Absolute perfect chart pattern. Right now, move. I should be on it already, but I'm waiting for the weekly close. I don't mind paying up for it a little bit. Okay. At some point, I'm going to get on AT&T after it corrects. So it's had a huge run off the low. Got the Fibonacci retracements. When it retraces 50% of the move, I'm going to add AT&T and Verizon. When they retrace 50% of their move, and they will. AT&T and Verizon, they don't ever run away. They're not innovative growth stocks. They're dividend payers. They had good earnings announcements. They blew out on the earnings announcements. They'll consolidate. I'll be on those names. So we're going to be putting our cash to work in the dividend payers, in the defensive stocks. Continue to do that. So I haven't even touched on Bitcoin, okay? But Bitcoin is in the process of a collapse. Now, we talked about this together back here. In fact, we've been talking about it since the peak in October. And I've been sharing with you guys the concern here, right? Is Bitcoin's one of 3 things is happening to Bitcoin. One thing we're going to put aside because I don't really believe it, but there's something wrong with Bitcoin. And we're going to find out what that is later. I don't know what it is, like something structurally wrong with Bitcoin. That's one scenario. I don't really believe that, but it's possible. The other 2 scenarios are, 1, Bitcoin is the lead risk on asset. That's what I've been saying for years. I don't mind trading it. We've made a lot of money trading it. We're having fun together, right? But I said to you a while ago in October, as it was breaking down and the market was going up, that's a negative divergence for the market. So if Bitcoin continues to be a leading, that's the canary in the coal mine, a leading risk on asset. It's the canary in the coal mine of liquidity being drained from the system. If there's liquidity being pumped in, bang, Bitcoin loves it. If liquidity is being drained, it's the first asset to crater. And so for a while, the Nasdaq 100 can levitate without liquidity. People don't realize it. Innovative growth stocks can levitate. Bitcoin's the first to crater. That alligator jaw collapses when innovative growth and the Nasdaq 100 catches up to Bitcoin, and Bitcoin is accelerating down. So that's the second scenario. That's a reason why I'm concerned about the market in general. And of course, the third scenario is that people have been trying to pretend that Bitcoin's the new gold and Bitcoin's going to save you from fiat, whatever. And obviously that's wrong. So you can just take that, throw it out the window. Bitcoin's got nothing to do with protecting assets because it's decentralized and it's going to help you against fiat. That's a complete fallacy. All right. And I've been saying that for a long time. Okay. It just is. Okay. And I think that debate is totally over now. You can't argue it anymore. Gold and silver have skyrocketed as the dollar went down this year because they're the things that protect against fiat collapse. Bitcoin cratered with the dollar. So that there's no such thing as that argument anymore. You can't argue that. It doesn't work. All right. So it goes up when liquidity is being added to the system, and it's the first to crater when liquidity is being reduced from the system. And we've been watching that happen since October. So on this desk, we've been taking advantage of that because we're short MicroStrategy. Okay, we own puts. We started doing that back here in October. We had puts all the way down in here. Then we took a break for a while as it tried to make a bottom. And it tried to make a bottom at the 1-to-1 ratio. If you remember, I said to you up there, I don't know who in their right mind pays micro for strategy stock when it was trading at multiples of its net asset value to Bitcoin, right? So all the Bitcoin ever bought by strategy, the average price is $76,037 last time I checked. So why would anybody pay more than that, right? So people were paying for it up here when the net asset value was down here where this blue line is, okay? So that was a no-brainer short. That was just a premium collapsing. Now what we have is something else going on, right? So this was just a premium collapsing. That was an easy short. This breakdown is because now strategy, now all of the strategy holdings, right? 76,000, which is somewhere around this yellow dashed line on this chart. This is IBIT, right? So just to give you an idea, this is IBIT. You can look at any Bitcoin ETF, but right around that yellow dashed line, that's the average price of all the Bitcoin ever bought by strategy. Right now, we're at 75,174 on Bitcoin. So we're below the average price, meaning all of the action, all of the borrowing, all the preferred stock, all the convertible debt, all of that stuff to buy Bitcoin is now underwater. And this stock is the whipping board, right? We know what happens to this company because the last couple of preferred stock deals that strategy did, we all know this, it was in the fine print. You can't call it a Ponzi scheme because it's not a scheme. He's been very honest with everybody. It's right out there in the paperwork, in the fine print. If they can't pay the preferred dividend, they'll sell more common and give the money to the preferred shareholders. Who's the sucker that's going to buy that deal is the question I want to know. When they come to sell more strategy stock so they can give the proceeds to the preferred guys, who's going to be out there as part of that deal? I don't know. I don't know. It won't, I mean, who would do that? Who would be that sucker? I don't get it. Anyway, I think the stock's going a lot lower. So the bell just rung. I got to get to our trading desk today. But I just wanted to share these thoughts with you. I'm concerned. I'm watching for the weekly numbers before I make any major changes. I've got a lot of cash on hand. Our investments, I mean, we were up yesterday. We're making money again this morning. The market's coming in. So let's just round it out with where will we go with capital. All right, let's round it out with precious metals. Now, we're long and strong physical gold. I'm not changing that position. It's a long-term hold. I'm using stops that are lower. I haven't touched it. We booked massive gains on silver and the mining ETFs. This is my strategy going forward. I probably am not a buyer of silver again right now. I don't want to own an asset that drops 30% in 3 hours. I just don't. I don't need that risk. I don't need it. If the volatility compresses again and we get a tight chart pattern again, I might go back at silver. I might. But where I'm really leaning now is that we should be going into that investment phase, this part of the precious metal cycle, where the earnings announcements out of the mining stocks should just be gangbusters. I mean, we know what the costs are, and we see what the prices have skyrocketed to. So it doesn't matter if silver is $75 an ounce or $100 an ounce or $150 an ounce. The silver mining companies, the earnings numbers should be just blowout this year. We should start seeing it tomorrow with Barrick when they announce earnings. You could drive a truck through the margins now. So what I'd like to do is shift now and buy my favorite mining stocks for the next leg higher in this evolving precious metals investment theme that we've been so successful on. So these are the stocks at the top of my whiteboard that I'd like to put into the portfolio, and we'll see how I do it. First of all, Barrick, we're going to see what they do with earnings. It's going to be really interesting to see what the earnings number is and the reaction to the street, okay? They blow it out or do they break it down? It's going to be very interesting. I'm going to watch that tomorrow. It's going to go a long way towards adjusting how I look at the next step for me in the precious metal stocks. I want to own Newmont, Wheaton Precious Metals, and AEM and Barrick. Those are the 4 gold mining companies I want. Of course, Wheaton's got some silver in there too, but it's gold and silver, okay? So those are the big 4 that I want to own. And then I'm going to get back on Coeur d'Alene. We traded it great. We bought it down here, sold it in the yellow and pink boxes. It cratered, but I want to get back on it down here. And Pan American, okay? Those are the what did I say? Those are the 6 stocks that I'd like to own for the next leg higher in the metals. Because, you know, these should be like huge earnings and revenue winners with margins expanding like this. So that's the next step for me. So they've cratered down to the 25 or the 50-day moving average. They're going to build a base in here, and then that's where I want to go with my next step when it comes to investing. And we might own maybe 4 or 5 of our micro cap mining stocks. Now's the time, because what probably is going to happen when these companies get flush with cash is they're going to start buying gold in the ground. So some of the smaller names are going to get taken over. So I'm going to take my time here. I would expect at least 4 to 7 weeks of a tight consolidation has to occur before the next leg up. But depending on how they respond to Barrick's earnings tomorrow, I might change my timeline there. Okay. So those are my thoughts right now. I'm going to have to split here. We got to get the live trading desk going. Any questions you got? Let me see. Okay, so the question is very good. Somebody's asking me a question. It must be a long-time follower on YouTube, and thanks so much for asking this question. It's great. You're saying that you remember me saying when they come for everything. So you're asking me, does it make sense to own the mining stocks? Does it make sense to own the dividend pairs? Because when they come for the market, they come for everything. That's the end game. That's the end game. Okay. So what happens first is they come for big cap tech. It's breaking down. AT&T's breaking out. Tobacco's breaking out. Chevron's breaking out. And that could go on for 6 months. In late 21, early 2022, we had an ARMR Insider on the desk, Eras, and he made an absolute fortune in the energy stocks for 6 months. They went up huge before they finally got to energy stocks. So at the end, they come for everything. But there's a rotation that opens a window where you can make a lot of money, okay? And so shifting there can be very successful as they're coming out of big cap tech. If the selling gets bad enough, if the Fed's raising rates and doing quantitative tightening, yeah, man, they're going to get to everything. But that's a little bit further out. So that's a very good question. Thanks for asking it. All right, guys, listen, if you have any questions, throw it in the comment section. I'll look at this during the day. ARMR Insiders, just give me a minute. I'll get the live trading desk started and we'll go all day together. ARMR Report subscribers, you're on your own. You can always pick up the phone and call me if you need extra help. That's part of the process of being part of this ARMR crew, if you will. Don't forget, guys, you can go to our Substack where we post our weekly updates on how we've addressed the market during the week and what we think we'll be doing the following week. That's free. It's armorinvesting.substack.com, ARMR investing.substack.com. So you can join us there just to get some of the information flow. At the end of the day, guys, don't forget whatever I'm saying, whatever you read somewhere else or hear somewhere else, you've really got to think for yourself. You've got to figure out what your risk tolerance is, what your goals are. You got to execute your own strategy. And you got to be the smart money. Have a great day trading, guys.
Mm-hmm.